Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. So we're launching into a discussion today, and it's interesting because it feels less about just looking back at the Q3 numbers,
Right. I mean, the numbers were strong, incredibly strong, actually.
Yeah, exactly. But this feels much more about mapping out the future. What really jumped out is this significant strategic shift, a really big focused step up in how they're thinking about long-term capital.
That's spot on. It signals real confidence. When a company's core engine is performing this well, that's when you see them start dedicating serious resources to building the next generation of everything.
And that engine analogy works perfectly, doesn't it? Because the core business isn't just taking over.
Not at all. It's actually accelerating. Fourth straight quarter of accelerating growth. Unit economics are improving. Profit dollars are really starting to stack up nicely. And it's that foundational health, that powerful engine that's basically funding what management described as several hundred millions of extra investment, mostly hitting in 2026.
Okay.
And importantly, this isn't just, keeping the lights on. This is deliberate spending designed to stretch out their growth runway, create massive future value.
So if we think about the Q3 presentation as like the blueprint for this future vehicle they're building, our mission today, for you listening, is really to break down the key parts of that blueprint. We're zeroing in on, I think, 3 core areas.
Yeah, that sounds right.
First, those huge tech investments for 2026, specifically this move to what they're calling an AI-native global platform. That sounds massive.
It is. It's foundational.
Second, the whole strategy behind these completely new product areas. Things like, customized autonomous delivery and really trying to perfect fulfillment services.
Right, the next growth vectors.
And third, the really critical work that's going on integrating those new international pieces, especially Deliveroo.
Yeah, bringing Europe fully into the fold. It's a huge undertaking. #Tech2. The strategic rationale for major 2026 investments.
Okay, let's start right there with that massive investment number. Several hundred millions planned for next year. That's a lot of money.
It is. It's significant.
And management specifically called out significant temporal costs. Before we even get into where the money's going, can we just unpack that term? What exactly are these temporal costs?
Yeah, that's a really good place to start because it frames the whole investment. When they say temporal costs, they basically mean the upfront temporary hit they have to take to run systems in parallel.
Okay.
Think of it like trying to swap out the engine of a Formula One car while it's still mid-race. It's complicated.
Right. You can't just stop.
Exactly. So they have to spin up extra computing power, extra cloud servers, and they have to maintain maybe 2 or even 3 versions of their software stack at the same time while the new unified one is being built and tested.
Ah, okay. So that's where a chunk of the cost comes from initially.
A big chunk. They're basically accepting this short-term financial drag, this extra expense, because the long-term payoff, the efficiency, the speed is expected to be so immense.
That makes sense. It clarifies the sort of short-term pain for long-term gain idea. Now, looking at that long-term rationale, the philosophy underneath it all still seems really anchored in discipline, right? Even with this huge spend.
Absolutely. Yeah, that came through very clearly. The commitment is still laser-focused on the internal rate of return, the IRR of every single project. They're making sure every dollar spent is aimed squarely at maximizing long-term free cash flow per share. That's the North Star. So they're not just spending for the sake of it, they're investing very specifically to extend the duration of their growth, hopefully for years to come.
Got it.
And this several $100 million, it breaks down into really 3 main buckets, 3 primary investment areas.
Okay, let's break those down. Bucket number 1 seems like the absolute foundation for everything else. Building the new global tech platform. Why is this the most critical piece for the long run?
It's critical because right now, if you look under the hood, mainly because of the big strategic acquisitions like Wolt and more recently Deliveroo.
Right.
The platform essentially operates like 3 separate tech companies glued together. So think about it. An engineer sitting in, say, the US develops a really cool new search feature or some optimization. To get that out to all users, they might literally have to run that experiment and deploy the code 3 separate times Once for the DoorDash audience, once for Wolt, once for Deliveroo.
Wow, that sounds incredibly inefficient.
It is incredibly inefficient. It's a massive drain on very expensive engineering resources. It slows down how fast they can innovate globally. And, it increases their cloud costs just due to all that redundancy.
Okay, so the core investment here is really about unification, getting to one single global tech stack, so one feature ships everywhere instantly.
That's the goal. One push, global impact.
But why is the cost of doing this unification hitting now? And why is it so expensive beyond just, moving code around?
This is where it gets really, really interesting. And it goes way beyond just migrating databases or merging code bases.
Okay.
They're not just moving code. They are fundamentally rewriting their software for an AI native architecture.
AI native architecture.
The CEO actually made a point of saying, look, if we were starting this company from scratch today, we would write our software completely differently because of AI.
Right.
So this investment is basically a recognition that the fundamental way you embed these kinds of platforms has to change if you want to truly maximize the power of generative AI and machine learning.
Okay, let's really unpack that AI native concept because, like you said, that sounds like a lot more than just using some AI tool to help write emails or something.
Yeah.
How does this architecturally redefine the whole platform?
Yeah, it's a fundamental shift. It's about moving away from purely deterministic code.
Yeah.
Where input A always gives you output B, towards more probabilistic systems that are built around what they call agent workflow.
Agent workflows?
Yeah. So in a traditional system, an engineer builds a very specific API call to do a specific thing. In this AI native world, the engineer is more like defining the goals for an agent, which is basically a sophisticated AI model.
Okay.
And that agent uses deep learning to dynamically figure out the best path forward for a customer trying to order or for a dasher trying to find the most efficient route. It's much more fluid and adaptive.
That sounds like it requires completely new tools, new ways of thinking for the engineers.
Totally. They mentioned they're rethinking everything. How do you even test a system like this? You can't test a probabilistic system the same way you test deterministic code where you expect one specific answer.
Right.
They're redefining deployment processes, figuring out how you update these complex models on the fly without, accidentally breaking the entire marketplace.
That sounds like an enormous undertaking, a huge risk too, maybe. What's the big competitive advantage, the moat that this creates? And why do this massive overhaul now instead of just sort of bolting AI features onto the existing platforms?
Well, the moat is really about long-term sustainability and speed. Think about it. Competitors who just bolt AI onto their old legacy systems will always be dealing with the friction and limitations of that underlying architecture.
Okay, makes sense.
This rewrite, if they pull it off, allows for true efficiency gains down the line. Imagine if this new global stack can handle everything: demand forecasting, dasher routing, customer personalization, using maybe a single incredibly optimized AI model that's deployed everywhere.
Wow.
That directly leads to a better cost structure, much faster development velocity globally, and crucially, it frees up all those highly paid engineers from doing repetitive work, like deploying the same feature 3 times.
Right, lets them focus on the next big thing.
Exactly. They can focus on solving the next set of major customer problems. So they're basically trading these high short-term temporal costs we talked about for potentially immense long-term operational leverage. It's a really strategic infrastructure play. This is something that should pay off for, the next decade or more.
Okay, so that establishes the foundation bucket 1. This powerful, unified AI native engine is under construction. What's it going to power? That seems to bring us neatly to bucket 2, new product commercialization.
Exactly right. This fits perfectly with their established product playbook. You know how they operate? Start with small, cheap experiments.
Right.
The ones that show real promise, that achieve product market fit, they graduate those to commercialization. That's where they really test the business model. And the winners from that stage get scaled up to become the next generation of cash-generating businesses for the company.
And it sounds like several products are now hitting that major investment graduation phase.
That's right. We heard about 3 specific areas getting significant funding now. First is in-store offerings.
Okay.
This is really about the recognition that the company can be the bridge between local businesses and consumers, whether they're ordering for delivery or deciding to actually go out.
Expanding beyond just delivery.
Exactly. So they're commercializing the going out product, which includes things like restaurant reservations, and they're heavily integrating the 7-room CRM platform they acquired. The idea is to give restaurants much better tools to manage and engage with their dine-in customers too. It's moving beyond the kitchen into the whole restaurant experience.
Interesting. And the second area, autonomy, that's obviously the most futuristic sounding one and probably the most capital intensive.
Oh, for sure. It is. They're definitely moving past just running small pilot projects now and getting into serious commercialization with autonomous vehicles.
Okay.
And they specifically called out significant funding for something called the DoorDash Dot.
The Dot.
Yeah. And they described it as a customized, purpose-built autonomous vehicle. The fact that they're actually designing and funding their own hardware specifically tailored for delivery.
Yeah.
And designed to operate flexibly roads, sidewalks, bike lanes, that signals a really long-term serious commitment. It's way beyond just playing around with some off-the-shelf robots anymore.
Okay, that's a big step. And the third product area getting major investment, DashMart Fulfillment Services, or DFS, that seems aimed at solving a huge current headache in non-restaurant delivery.
Exactly. DFS is all about creating the capability for basically any retailer, big or small, to offer same-hour or same-day delivery with what they're aiming for is near-perfect accuracy.
Near-perfect accuracy, that's the key phrase.
It absolutely is. They're tackling the inventory problem head-on, because that's arguably the single biggest reason customers are sometimes hesitant to trust, getting their groceries or other retail items delivered super fast.
Yeah, getting the wrong thing is frustrating.
Hugely. So this requires investing really heavily in the underlying fulfillment systems, the whole process.
Okay, let's tie this back to the money for a second. The CFO, Ravi Indukonda, gave some really important guidance that kind of wraps up this whole investment rationale. What did he say about profitability for 2026, given all these huge upfront costs?
Yeah, this was maybe the most powerful signal of their confidence in the core business and that engine we talked about.
Yep.
He basically guided that the EBITDA margin for the existing business, and this is a really critical distinction he made, the existing business, including these hundreds of millions in new strategic investments.
Right.
But excluding the financials from the newly acquired Deliveroo business,
Got it.
is still expected to be up slightly in 2026 compared to 2025.
Wow. So even with all this extra spending, the core is still getting more profitable.
Exactly. It means the underlying profitability improvements in their main marketplace business are so strong, so profound, that they can actually absorb this massive acceleration in long-term strategic spending and still show margin expansion on that core.
That's incredible.
It really is. It shows they're making these big bets from a position of significant strength, not out of desperation or necessity. Tag 3, international expansion, and the Deliveroo integration.
And that financial strength, that confidence coming from the core U.S. market and also from Wolt's performance.
Yeah.
That's precisely what allows them to be aggressive in funding that third big bucket.
Huh.
The Deliveroo integration. I mean, post-acquisition, they have a serious footprint now across sort of over 20 countries, heavily focused on those big, profitable European city centers.
Yeah, it's a major international presence now.
So how are they actually approaching the integration now that the deal's done and dusted?
Well, the first piece of news was actually quite positive. Management said that when they really got under the hood of the Deliveroo business, they found it was in better shape than expected.
Now, that's always good to hear after an acquisition.
Absolutely. And that initial assessment immediately gave them the confidence to actually step up investment rather than just coming in and focusing purely on, slashing costs right away.
Okay, so what's the strategy then?
It's very much product first. It really echoes the playbook that worked so well for them when they acquired and scaled Wolt previously. The immediate #1 priority is intense investment in the Deliveroo product itself. They're aiming to get Deliveroo's key metrics, things like customer retention, order frequency, overall engagement, up to best-in-class levels.
And they're using lessons from both platforms to do that.
Exactly. They're drawing on the best features, the best learnings from both the original DoorDash platform and the Wolt experience, applying that combined knowledge to the Deliveroo app and operations.
So they're prioritizing growing the user base and making the experience great, even before they necessarily see all the financial benefits, the synergies from combining everything.
And that's exactly the approach. They're putting money into the product first before they fully realize the cost savings from, say, combining tech teams or getting better marketing deals.
Okay.
They're applying that same operational and product rigor, the focus on data, on iterating quickly that drove success in the US and with Wolt, into these new Deliveroo markets. The core philosophy hasn't changed. Focus relentlessly on making the product amazing for consumers and restaurants. Because if you do that, it inevitably drives scale. And scale inherently improves unit economics, which ultimately leads to more gross profit dollars. The cost efficiencies, the synergies, those will come, but they're not the primary driver here in year one.
That integration process itself, though, must be incredibly complex, especially since, as you mentioned, Deliveroo has to keep running smoothly for its customers.
Yeah, flawlessly, ideally.
While this massive new global platform, the AI native one, is being built underneath it in parallel, that sounds like a tightrope walk.
It is a phenomenal balancing act. The CEO specifically called this out. He said a significant chunk of those temporal costs we discussed earlier.
Right, the parallel systems.
That extra expense of maintaining multiple cloud infrastructures and separate development teams, a big piece of that is specifically earmarked to ensure there's zero degradation, zero negative impact on the consumer experience in all those Deliveroo markets.
Ah, okay. So they're deliberately spending extra money up front.
Yes, deliberately incurring extra costs to make sure that Deliveroo can continue to grow and perform well on its existing tech stack, even while the new single global stack is being constructed and tested behind the scenes.
That makes a lot of sense strategically. You definitely don't want to mess up a good thing or slow down growth in those markets just to save a few bucks immediately.
Precisely. You protect the asset while you upgrade the foundation. It minimizes disruption and safeguards the double-digit growth they're already seeing in those acquired markets.
Okay, so what about the financial expectations for Deliveroo itself? How does all this investment factor into the contribution it's expected to make?
Well, as we touched on, the acquired business's growth is actually beating their initial expectations, which, again, just reinforces management's confidence to invest aggressively now.
Right.
They've guided that Deliveroo is expected to contribute around $200 million in EBITDA, but it's really crucial for listeners to understand. That $200 million figure is the contribution after they account for all this necessary product and operational investment.
Oh, okay. It's a net number.
It's a net number. It shows that even with the significant spending required to fully integrate the business and improve the product, the unit is already financially meaningful and contributing positively.
Got it. And what about those synergies we mentioned? We know they'll take time, but what are the main areas where they eventually expect to see savings or benefits from combining everything?
The synergies really fall into two main camps: scale and redundancy. Once they finally migrate everyone onto the single global platform, they can start eliminating redundant engineering teams working on similar problems across different stacks. They get rid of duplicate software licenses, things like that.
Makes sense.
And they also gain immense purchasing power, huge procurement leverage across things like marketing spend, cloud services, even general overhead, just by combining two large European operations into one managed entity.
But that's definitely backloaded.
Heavily backloaded. Phase 1 is integrate and improve the product. Phase 2, which is really enabled by getting onto that single tech stack, that's when you fully unlock the synergy potential. But again, the core focus, day in and day out right now, remains driving scale to maximize those gross profit dollars across the entire European operation.
So the overall message to the market, to investors, seems to be, look, we bought a really good business in Deliveroo. It's actually doing better than we thought, and so we're hitting the accelerator on investment to make it even stronger for the long haul, even if that means some of the cost savings get pushed out until this new global platform is fully operational.
That sums it up perfectly. It fits right into their core capital allocation philosophy. Put money where the expected return, the IRR, is highest. Focus on maximizing that long-term free cash flow per share, even if it requires some elevated costs in the short term. The Deliveroo story right now is much more about accelerating product adoption and growth in key European cities than it is about just cutting costs. #BuyV. Deep dive into new product vectors.
Okay, so we've covered the new tech foundation, that global AI native platform, and the international growth plan with Deliveroo. Now let's really dig into those two big, potentially game-changing bets that represent the future of delivery itself: autonomy and these perfected fulfillment services. Let's start with autonomy. What's the full vision here for this autonomous delivery platform they're building?
The vision is explicitly multimodal. That's key. They really pushed back on the idea that delivery's future will be dominated by just one single method, like only human dashers or only drones or only sidewalk robots.
Right, it's probably going to be a mix.
They believe it's going to be a mix.
Okay.
So their platform is being engineered from the ground up to incorporate all the viable ways to move goods locally. That includes human dashers, definitely. It includes land-based autonomous vehicles, both their own internal builds, like this Dot vehicle, and partnerships with external AV companies.
Okay.
And potentially down the road, even air vehicles like drones for certain use cases. The ultimate goal is to create this really dynamic, intelligent platform that can automatically look at an order's requirements, size, distance, urgency, cost sensitivity, and then select and dispatch the absolute best fulfillment method, the one that offers the highest quality and the lowest cost for that specific customer need at that specific moment.
So it could be a dasher for one order, the Dot for the next, maybe a partner's vehicle for another?
Exactly. A truly blended fleet, optimized in real time.
Now, this DoorDash Dot, that's the first specific piece of custom hardware they're putting serious money behind for commercialization in 2026. Building your own hardware is notoriously difficult, capital-intensive, and risky. What happens if, say, this specific Dot design doesn't scale well? Or maybe regulatory hurdles in key cities prove tougher than expected? Is there a plan B?
That's a really critical question, and it speaks to the kind of discipline you need when you're making these deep tech long-term bets. From their commentary, it sounds like they're mitigating that risk with a two-pronged approach. Internal builds and external partnerships running in parallel.
Okay. Hedging their bets a bit.
Kind of. The Dot represents their current best guess, their internal hypothesis on what the ideal vehicle form factor might be for certain types of deliveries. Specifically one that can, as they said, operate pragmatically across roads, sidewalks, and bike lanes.
Right. That flexible operating domain seems key.
But if the Dot runs into major roadblocks, maybe manufacturing costs end up being too high. Or maybe a big city bans sidewalk robots entirely, they still have the underlying software platform.
The autonomous delivery platform itself.
Exactly. That software layer is designed to be flexible, so they could potentially pivot and integrate more deeply with an external hardware partner whose vehicle is approved, or maybe shift focus to a different type of vehicle, like a drone partner, that can still plug into their routing and remote assistance software. The biggest investment is arguably in that software intelligence layer, even though the Dot is the physical thing we see right now.
Okay, that makes sense. Software flexibility is key.
And they're also being extremely realistic, very pragmatic, about the timeline for scaling this. They keep emphasizing, this is not an overnight switch to robots. Full scale is going to take a long, long time.
Why so long? What are the big hurdles?
Oh, the complexity is immense. First, you have to actually manufacture reliable hardware consistently at a viable cost. That's hard.
Yeah.
Then you have to integrate that hardware perfectly with the AI native software doing the driving and routing.
Right.
And maybe the biggest piece people underestimate is building out the entire support infrastructure. You need repair depots. You need teams of remote operators, humans ready to take over teleoperationally if a Dot gets confused or stuck.
Yeah, the edgy cases.
Exactly. And then there's the whole challenge of working with dozens, maybe hundreds of different city governments, each with their own rules and permitting processes. It's a marathon, not a sprint.
So this big 2026 investment in autonomy, it's really buying them commercial validation in specific markets, proving the model works, rather than aiming for robots delivering everywhere immediately.
Precisely. You have to make these critical, expensive, often irreversible decisions, like finalizing the Dot's design, setting up initial manufacturing lines. You have to make those decisions now, potentially years before you see the full benefits in terms of lower delivery costs or better service quality.
Right.
They're making those costly upfront commitments because they believe if they wait, they'll lose the long-term efficiency advantage to whoever does move first. It's a classic long-duration technology investment cycle.
Okay, let's pivot now to the second major new vector. DashMart Fulfillment Services, or DFS. This seems designed to tackle that massive frustration point in non-restaurant delivery. Inventory accuracy. Can you elaborate on just how big a problem that is and how DFS aims to solve it?
Yeah, this problem is fundamental to why ordering, say, groceries or convenience items online for fast delivery can sometimes be, well, annoying.
Right, you order 5 things, you get 3, 1 is wrong.
Exactly. Traditional physical retailers often have a huge disconnect between what their computer system thinks they have in stock on the shelf and what's actually physically there when a picker goes to grab it.
It happens all the time.
All the time. And that leads to errors, annoying substitutions, sometimes outright cancellations. It severely damages the customer experience. If you pay a premium for same-hour delivery and you don't get what you ordered, or only half of it,
You're not going to do it again soon.
you become incredibly reluctant to use that service again, especially for anything important. And that lack of trust, that low accuracy, fundamentally prevents the category from scaling the way restaurants have.
Okay, so how does DFS fix this? What's the mechanism?
DFS is designed to basically eliminate that friction by taking control of the whole end-to-end process for participating retailers. They're not just relying on the retailer's potentially chaotic in-store inventory data or having store staff do the picking. Instead, for products fulfilled through DFS, they manage the inventory system, they manage the picking and packing workflow, potentially even the warehousing itself. By integrating really deeply and controlling that physical flow of goods. Yeah. They believe they can achieve what they called almost near perfect accuracy. And that's the magic phrase. Because when the customer knows they will get exactly what they ordered reliably, their willingness to use and pay for same-hour service just skyrockets.
It really does change the whole proposition for ordering non-food items quickly.
Yeah.
How does this actually work with the retailers? Is it like they build separate DashMart warehouses everywhere, or is it more flexible?
It has to be incredibly flexible, which is partly why the investment is needed now to build out these different capabilities. It's definitely not a one-size-fits-all model. It's customized based on what that specific retail partner is trying to achieve.
Like what? Give us some examples.
Okay, so a big national retailer might use DFS to launch their brand in a completely new city or region where they don't currently have any physical stores. In that case, DFS might operate from a dedicated fulfillment facility, like a localized hub just for that retailer's products.
Got it. Like an instant market entry tool.
Exactly. Or another partner, maybe one who does have stores in a city but wants denser coverage or faster delivery times, they might use DFS to supplement their existing footprint, maybe handling deliveries in certain zones.
Okay.
Or, and this one is really interesting, a retailer could actually utilize unproductive square footage inside their existing stores. They could carve out a section, maybe in the back room, and transform that dead space into a dedicated DFS fulfillment node. It would be managed by the platform systems and potentially staff, essentially creating these little micro-fulfillment centers hidden inside existing retail locations, all powered by that high-accuracy DFS inventory system.
Wow, that's clever. Turning unused space into a delivery hub.
Yeah, it offers huge flexibility for the retailers.
And this capability, this focus on accuracy, it unlocks a massive amount of potential selection that just wasn't practical for fast delivery before, right? We saw that kind of surprising example in the materials about home improvement.
The mulch. Yes, that was the standout anecdote, wasn't it? It really illustrates the scale and the kind of versatility they're aiming for.
Tell us about the mulch.
They mentioned that during peak season, they are literally delivering thousands of pounds of mulch per day through the platform. Mulch.
That's amazing. I mean, that's bulky, it's heavy, probably pretty low margin.
Exactly. It's the kind of thing you traditionally think is completely unsuitable for on-demand delivery. The fact that their system, presumably leveraging DFS principles and maybe specialized dashers or partners...
Right, you probably need a pickup truck for that.
You definitely need more than a scooter. The fact they can efficiently handle thousands of pounds of landscaping material shows that DFS isn't just about getting your pint of ice cream right. It's about solving fundamental supply chain challenges for goods that are way outside the typical grocery or convenience box.
Does delivering something like thousands of pounds of mulch require a totally different type of dasher? Or is DFS maybe operating its own fleet for these heavy, bulky items?
That's where the multimodal strategy really comes into play immediately, isn't it? For something like mulch or maybe large appliances or furniture pieces fulfilled via DFS in the future, they'd almost certainly leverage the segment of their existing dasher network that uses larger vehicles, pickup trucks, vans, and compensate them appropriately for handling those kinds of loads. Or they might integrate with specialized third-party logistics, 3PL partners, who focus on heavy goods, but have them interface directly with the DashMart fulfillment and scheduling system.
So the key is the accurate inventory and the smart dispatching.
Exactly. The DFS system knows exactly what needs to be picked up, where and when, and the logistics platform can then match that need with the right type of delivery resource, whether it's a standard dasher, a dasher with a truck, or a 3PL partner. It's the accuracy and the flexible fleet working together that makes delivering mulch feasible, whereas a traditional retailer trying to do that on their own would likely just fail or find it prohibitively expensive.
Got it.
And ultimately, this whole DFS effort ties back to the massive untapped market opportunity they see. Management pointed out that today, only a tiny fraction, like a small single-digit percentage of the tens of millions of different items available locally in a typical city are actually orderable for delivery through their platform.
Wow, really only single digits.
Yeah. DFS is the key strategy to dramatically increase that selection. It's how they plan to eventually realize that big, ambitious goal of bringing, as they put it, everything inside the city to the consumer reliably on a same-hour or same-day basis. Hashtag V, core business performance, growth drivers, and regulatory environment.
Okay, it's really important we stress this again. All of this ambitious, forward-looking strategy, the AI platform rewrite, the DoorDash Dot, the DFS investments, it's all being paid for. It's all funded directly by an incredibly robust, high-performing core business right now.
Absolutely fundamental. You can't make these big bets without a strong foundation.
So let's just take a moment to review the health of that core engine, the U.S. marketplace primarily, restaurants, and the other verticals, and what's really driving this continued success.
Yeah, the core marketplace is frankly operating exceptionally well. To deliver 4 straight quarters of increasing strength, accelerating growth on the enormous base they already have, that's phenomenal performance.
It really is.
And management was clear. They don't attribute this to some, a single recent marketing campaign or promotion. They credit it to the compounding effect of long-term product improvements, things they actually started working on 3 or even 4 years ago.
So it's that patience and discipline finally paying off in a big way.
Exactly. That consistent focus is yielding massive results now.
Can you give us some specific examples? What were some of those long-term product improvements initiated years ago that are really hitting their stride now and leading to this sustained strength?
Sure. They always talk about the 4 key pillars: selection, quality, affordability, and service levels. So on service levels, for instance, improvements they started making years ago in their mapping technology and their batching algorithms, how they group orders for dashers.
Right.
Those are now mature and creating much higher efficiency for dashers. That translates directly into faster delivery times for consumers and often a lower cost per order as well.
Okay.
On selection, it's the sustained multi-year effort to onboard not just the big national chains, but also thousands upon thousands of unique local restaurants and small businesses. That depth of selection means customers are much more likely to find exactly what they're craving, which keeps them coming back.
Makes sense.
And on affordability, it's things like the multi-year investment in developing sophisticated tools like tiered delivery fees, different pricing options, and much better search personalization. So the platform gets better at showing you specifically the best value options for what you want right when you want it. That drives frequency.
Got it. It's a combination of all those things working together over time.
Precisely. And the net effect of this sustained focus is that they're continuing to lead the market in acquiring new customers, those crucial new monthly active user or MAU cohorts. And that's happening across all the segments: restaurants, grocery, and general retail.
And they mentioned this focus on new users creates something they call the bow that lifts all cohorts. Can you explain that? What's the network effect that they're describing there?
Yeah, it's a great analogy. The idea is that the newest group of users coming onto any platform, the newest MAU cohort, typically has the highest expectations. They're used to the latest tech. They demand speed, convenience.
Right. They're the most demanding.
They are. So when the platform invests in building new product features or improving service levels specifically to satisfy these demanding new users, the benefits don't just accrue to them. Those improvements, faster delivery, better app usability, more accurate ETAs, are immediately felt by all the older existing cohorts of users as well.
Okay. So improving for the new helps everyone.
Exactly. Everything gets a little faster, a little more accurate, a little more convenient across the board. And that leads to better retention and higher ordering frequency across the entire user base, which maximizes the lifetime value of every single customer. It becomes a virtuous cycle. Better product attracts more users, which generates more order volume, which improves dasher efficiency and earning, which allows further investment in the product, and so on.
And the value of getting users to shop across multiple categories, that multi-shopping behavior, that seems to be really resonating too, judging by the subscription growth numbers they reported.
Oh, absolutely. They said both DashPass in the US and Wolt Plus internationally had a record quarter for subscribers. The consumer psychology here is pretty straightforward, right?
Yeah.
Once you're paying a monthly or annual fee for a subscription, you are highly motivated to consolidate as much of your local shopping as possible onto that platform to get the maximum value out of your membership fee.
Makes sense. Get your money's worth.
Exactly. So it naturally drives that multi-category shopping behavior. People who signed up maybe just for restaurant delivery start exploring grocery or convenience or retail offers because, hey, the delivery fee is covered. And that really cements the platform's role as potentially the single operating system for all your local commerce needs.
Okay, speaking of those other categories, the new verticals, as they call them, grocery, convenience, retail, they're still growing really fast, leading in order volume share in many markets. But where do the unit economics stand for those categories now? Are they profitable yet?
The unit economics are definitely moving in the right direction. They showed continued improvement both sequentially, quarter over quarter, and year over year. The management team was pretty clear, though. The path to profitability, or even just clear break-even visibility for these newer verticals, is highly dependent on getting more scale and continuing to refine the operations.
So still needs work compared to restaurants.
Yeah, unlike the core restaurant business, which is mature and highly optimized, these new verticals often still require significant investment in the underlying processes, things like making in-store picking more efficient, improving inventory management systems, which DFS is tackling, optimizing delivery for different types of goods.
Okay.
So right now, they're prioritizing driving scale, getting more volume through the system, because they know the demand is there. They said a quarter of their total users are now ordering from these new verticals, which is huge.
Wow, 1 in 4.
Yeah. And the frequency of orders and the average basket size are both steadily increasing, so they know customers want this stuff delivered. The remaining challenge is just perfecting the logistics and the economics at really high volume.
And that user behavior, getting people to try new verticals, that creates a powerful kind of cross-pollination effect too, right? Helping the restaurant side.
It absolutely does. It effectively creates a whole secondary channel for acquiring new users for the entire platform. Someone might try the service for the very first time, not for a restaurant meal, but for, a late night snack delivery from a convenience store, or maybe a quick pharmacy run when they're sick.
Right.
Once they have that positive first experience, they see how fast and reliable the platform is, they're then highly likely to think of it the next time they want restaurant food delivered. It draws them into the ecosystem and often leads to them becoming those valuable multi-shopping accounts. So it's a really effective and complementary way to grow the overall user base beyond just focusing on restaurants.
And beyond the obvious categories like grocery and convenience, the materials flagged some other, maybe surprising, high-growth areas within new verticals.
Yeah, the diversity of what's growing is pretty striking. They called out pets, things like pet food, toys, as a really robust category that performs well all year round, not just seasonally.
Okay.
Health and beauty products are showing good traction. Electronics, understandably, tend to spike around the holidays and gifting seasons. And then we keep coming back to the amazing home improvement example.
Mulch.
The mulch, delivering thousands of pounds of mulch per day. That really confirms that the platform's logistical capabilities and efficiency are now enabling delivery for types of products that just a few years ago would have been considered completely impractical or too low margin for any kind of same-hour service.
It really expands the definition of what's deliverable. Okay, let's touch on the monetization engine behind a lot of this, the advertising business. Hitting $1 billion in annualized revenue is a huge milestone, and they apparently hit it faster than any other ad platform has before.
Yeah, that speed is remarkable. It really confirms the immense value of having that closed-loop marketplace data. When advertisers, restaurants, or CPG brands can place an ad directly on the platform and then directly measure the sales, the return on ad spend, ROAS, that resulted from that ad because the transaction happened right there. Okay, the advertising dollars follow very, very quickly. It's incredibly efficient for advertisers.
But there's always a balancing act with ads, right?
Always. The management team really emphasized the need for discipline here. The core tension in any marketplace advertising business is balancing the desires of the advertisers who want maximum visibility and ROAS with the experience of the consumer. You can't clutter the app or slow down the ordering process with too many intrusive ads, or people will stop using it.
Right, you kill the golden goose.
Exactly. So they stress they're maintaining a very strict balance. They actually mentioned that they currently have more advertiser budget wanting to be spent on the platform than they have ad inventory slots they're willing to make available.
Oh, interesting. So they're deliberately leaving some money on the table.
Deliberately leaving money on the table specifically to protect the quality of the user experience. That discipline is really key for long-term health. And importantly, the significant ad dollars they do generate, just like all the other efficiency gains they find in the business, those profits are immediately reinvested back into the core operations, improving service, lowering consumer fees, increasing Dasher pay all at healthy rates, fueling that overall growth engine we talked about.
Okay, finally, before we wrap up, we have to touch on the regulatory and labor environment. It's always a factor, especially in big urban centers where they operate heavily. What's the current status of Dasher supply, and how is management thinking about engaging with governments on these issues?
Yeah, it's a constant area of focus. On the Dasher supply side, management sounded quite confident. They reported that supply remains healthy, meeting demand. And they reiterated that they maintain highest standards when it comes to things like Dasher authenticity, background checks, ensuring workers are documented. They reported no major challenges to keeping the Dasher funnel full right now. This is an area where they've clearly invested continuously over many years, trying to make the Dasher experience reliable and attractive enough to maintain that supply.
And what about on the government relations side? There's always chatter, legislative pushes, particularly around worker classification, pay standards, benefits. What's their overarching stance or approach there?
Their public stance, the way they talk about it, is really grounded in pragmatism. They consistently emphasize that they believe governments and businesses need to work together collaboratively to find sensible solutions. Solutions that prioritize what consumers and workers actually want and need in the real world, rather than being driven solely by, rigid ideological positions.
Finding common ground.
Trying to find common ground, yeah. They pointed to their own track record, things like their longstanding commitment to affordability, being proactive, for example, in integrating S&P benefits for grocery orders, and also their commitment to Dasher protection. They highlighted that they were actually the first platform in the U.S., way back in 2019, to voluntarily offer occupational accident insurance to Dashers, even before any laws mandated.
Right, I remember that.
So their overall view seems to be, look, we're a for-profit company. Our goal is to maximize consumer choice and connect local businesses to customers as efficiently as possible. But they believe that goal is entirely compatible with finding progressive policy solutions, provided those policies are actually based on understanding the real-world operational complexities and what different stakeholders, consumers, Dashers, restaurants genuinely desire. The focus is on finding, as they put it, commonsensical ways forward that protect the flexibility Dashers value while also providing robust safety nets and fair compensation. #TagViews. Conclusion and listener takeaways.
Wow, okay. We have covered a huge amount of ground today. I mean, the big picture takeaway from this Q3 discussion seems crystal clear. The core business is firing on all cylinders, performing like a really efficient engine.
Yeah, incredibly strong.
And it's generating the serious cash flow needed to fund this massive strategic leap forward. And that leap really seems defined by convergence, doesn't it? Bringing everything together onto a single global platform, embedding AI deeply at the architectural level, not just on the surface.
Right, AI do.
And making this really focused push into what could be the next generation of delivery itself, through things like autonomy and these perfected fulfillment services.
Yeah, what stands out most to me is the sheer confidence that underlies that capital allocation philosophy. I mean, these are incredibly expensive projects, things like building custom robots or rewriting the entire tech stack. They take years. The payoff isn't immediate. But management is proceeding with real discipline, only doubling down on investment in areas like DFS or the Dot, once the initial products have shown they have real market fit. They're sticking to that North Star.
Yeah.
Maximizing long-term free cash flow per share. And they're doing it by building the infrastructure of tomorrow, today. It feels like a concerted effort to really extend their competitive lead and their growth runway for many years to come.
And a big piece of that runway, that future growth, leads directly through DashMart Fulfillment Services, DFS, and that promise you highlighted, near-perfect accuracy. We talked about how that suddenly makes delivering things like, well,
thousands of pounds of mulch.
Exactly. Thousands of pounds of mulch suddenly feasible.
Yeah, it changes the game.
So maybe here's a final provocative thought for you, the listener, to chew on. If they or someone truly cracks that code, if inventory accuracy for local retail is completely solved and all the friction of substitutions and out-of-stocks and errors just disappears, How dramatically could your expectations change for what you can get delivered within an hour?
Good question.
Think beyond just food and basic groceries. What about really specialized items? High-value goods. Things you currently assume you have to go out and get yourself. Maybe specific replacement parts for an appliance that just broke. Or specialized industrial components needed urgently on a construction site. Or even prescription medical equipment. Could those things become commonplace, expected to arrive at your door within the hour, maybe in the next 3 years?
It opens up a whole world of possibilities, doesn't it?
It really does. The platform that successfully solves that final nagging inventory accuracy problem at scale that could truly redefine the future of local commerce as we know it. Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.